All right. So, like we were mentioned, this is going to be incredibly fast, so bear with me. I will be around afterwards, but let's talk a little bit about how to launch a token without selling your soul and annihilating your community. I think one of the more prudent topics of the day. I'm going to start with something that I don't think is a big controversial truth, but it should set the stage for how we're going to talk today, and that is the price performance is indicative of most user experience in crypto. So when we think about tokenomics, we need to optimize for price from the get-go. This will usually start with the tokenomics and the value flows that underpin a protocol, but it also stems back to market maker engagements and how we strategically underwrite the token for what we would call a launch and listing strategy. Before I jump in, Forged is a free-to-use platform for all of this. You can design tokenomics, engage market makers, engage exchanges, and navigate that process, as well as after TGE, utilize the software to go ahead and monitor your market makers' contributions to the overall liquidity footprint. So start with tokenomics, and really what I want to come back to is sort of a core business assessment. What is the problem and solution that the project has actually identified, and how does that solution create value for the underlying stakeholders? Those can be token holders or others that are involved in sort of the cap table distribution, but we really want to understand what value accrual will come back to those sort of individuals. From there, we can start to model out supply. Supply starts with the distribution of who actually receives tokens, and then the emissions as to what cadence or what inflationary schedule they receive those tokens over. Modeling out demand comes down to a few aspects. We start with utilities and mechanisms that many of us are familiar with. Utilities tend to be more passive or more active in nature versus what we would say mechanisms, are more passive. So utilities are things like governance. They require people to actually put forward the token to utilize the underlying protocol. And they may have more friction involved than things like automatic yield distributions or staking for inflationary rewards, which are more on the mechanism side. I would be remiss not to mention speculation. When we think about demand and what typically will set the stage for early buy-side imbalance, this largely comes from speculative behavior. Speculation is not always bad, although it can be a bit of an unsurprising factor. So if we run simulations and we try to optimize for price, we see that results are subpar. There are optimizations that we can make. We can go back to that cap table and the distribution of the tokens. We can also adjust things like the cost basis associated with certain investor groups, as well as what maybe the opening FDV is, and how we then think about the demand drivers. What I want you to take away from this is that low float, high FDV is out of style. You should have 15 to 25% of your total supply circulating on day one. And it's critical that you actually understand but optimize for whose hands these tokens are in. As I mentioned before, governance should not be your only demand driver. You do need mechanisms that actually drive more passive behavior. Active behavior is not going to be something that everyone wants to participate in inside the protocol. And more than that, again, speculation is your friend. You want to have speculators involved in the price discovery process. They're a critical voice in what we say is helping determine fair market value. I want to move on to market makers. Market maker engagements tend to be very opaque by nature, but they're a critical aspect to having not only strong liquidity, but also, again, this price discovery period being maintained in an efficient way. Market makers, just to set the stage, do not provide liquidity out of altruism. They do so rather with the expectation of profit. And as a result, market makers need to be engaged in a very strategic way in crypto relative to how traditional assets or securities may work with these types of providers. Market makers expect to profit in different ways depending on the mechanisms or the actual market microstructure that they're operating on, but it holds true that they need to be in a position that they can make money. So two business models have emerged. In this, we have retainer and working capital market makers who are frankly very expensive. They require a loan of stable coins and tokens, or base and quote assets, as we would say, and they usually have a profit share with other monthly fees associated with them. On the other hand, you have loan plus call option market makers who only require tokens, but are given the right, not the obligation, to repurchase those tokens at predetermined prices thereafter. I like to see the world in zero sum. I think it generally helps understand the incentives of who I'm working with and what I expect to get out of an engagement. So retainer and working capital market makers are great core extensions of your team. They're treated as an asset manager, but again, they're expensive, and there's no downside for them if they were to lose your trading inventory. You, the project, shoulders that risk. It's very expensive for your treasury in that case. Loan plus call option market makers only require a loan of tokens, and therefore they can be seen as much cheaper, but they can only realize profit through what we would refer to as zero-sum trade activity. And so oftentimes these engagements turn predatory or parasitic in nature. I'm going to show you what that manifests as. So I think we've seen many charts that look like this. You can think of the x-axis as days post-TGE, where the market maker is forced to have their options priced very far out of the money. The market maker will then layer a very thin amount of liquidity at the open on what we would call the pre-market order books. They then begin aggressively selling into organic bid-side liquidity, or retail, who's buying your token. After the inflationary period, many weeks after TGE sets in, price usually depreciates thereafter. Market makers may exaggerate this to some point, but nonetheless, they have effectively sold high and bought back very low, thereby capturing a spread, never intending to exercise the options that you gave them. So you may think the options you give the market maker are how they're going to make money, but oftentimes this is a pricing exercise in order to make sure that the market maker is actually in a position to profit. If you were to say, well, what happens on the other side? What happens? Price appreciates beyond where the market maker was selling. Well, guess what? You've extended them a free hedge via these options. So they stand to capture the spread either way. Market maker is going to make money whether they exercise these or not in most cases. It may be counterintuitive. Your market maker needs to be in a position that they can profit. They actually need to be what we would call in the money with some of their options, such that they're not forced on that predatory engagement structure. I want to blow through exchange listings. One thing that always holds true from Forged's side is that we recommend both a centralized and decentralized exchange listing strategy. Involve both counterparties. You want to have curated price discovery on what we would call a bonding curve or a single-sided liquidity pool, such that your decentralized community is involved in price discovery before centralized exchanges get there. Centralized exchanges will engage in a highly manufactured process called pre-market order book structures. This pre-market order book structure will strategically underprice your token into the open, and we don't want that to blow through egregious valuations. So that exercise is usually more cumbersome, but from the exchange side of things, we think about, or we focus on, not only the trading KPIs for altcoins, but also the performance and the accessibility. So we think about what actually happens when we go to list on exchanges. There's price associated with them. We don't need to break the bank, and we don't need to ruin your treasury just to get listed in front of, be it the Binance user base or the OKX user base. I have here a screenshot of some recent price updates from all these major exchanges and how their listing activities deviate thereafter. In terms of Forge, in terms of how we can support, again, the exchanges and market makers and everything thereafter is very complicated. And so Forged, again, is free for all blockchain founders. You can sign up, you can utilize readings and resources of thousands of pages that I've written in my experience from the market makers and from the centralized exchanges. Thank you very much. I hope to talk to you guys soon.